may be discussed. Thanks again for trusting Trade Maestro with your trading education. We will begin shortly. For thousands of years, if somebody wanted to learn a new skill, maybe learn to make boots or horse saddles, how did they learn that skill? They studied with a master. Trade Maestro builds on this tradition, the relationship between the mentor and the apprentice, but we do it all online. The term maestro means master or an artist of consummate skill. And that's what a trade maestro is. It's a person who has mastered the art of trading. I didn't want to create just another stock market trading company that sells classes. I've done that, and I don't think that's in the best interest of my apprentice. I want to walk him through the process of becoming a great trader, and you don't get there with information overload. You get there by doing it, by getting your hands dirty, by putting in the practice. That's the only way to build a new skill.
I love how Jeremy teaches. I love the fact that he teaches things in such a real, practical way.
And he made me realize that I can do this.
I remember when I first started my trading journey, and let's just say I blew up at least 2 accounts.
I know this model of learning to trade works. I've had the opportunity to work with people from over 80 different countries.
And I was skeptical at first. I was kind of like, okay, are you sure about this?
I was always chasing stocks. I would always chase the next top thing and never had an opportunity to get any profit from it.
I've helped people with trading accounts that are just a few dollars, and I've helped people with trading accounts that are over $1 million.
These courses give me a much wider perspective on what is really possible.
And what Jeremy does so well is that he breaks it down in a simple form so it's easy to understand.
They're just regular folks, and if I can teach them, I can teach you.
I didn't want to let someone else tell me what the play was, and I just followed their lead. I wanted to learn it for myself.
My greatest joy is when somebody that I have taught over the last decade, they reach out and they say something like, you won't believe it, but I actually have people that are asking me to teach them how to trade. Is that okay? You think I can teach them?
Working with you taught me that, stocks go through ups and downs pretty regularly and pretty predictable.
The portion that my husband has now been able to take over and own has outperformed the market and is doing better than the rest of our retirement. It is totally life-changing.
Just to think that I touched people, I taught them to do something, I influenced a generation of traders, and now they're taking it forward and they're influencing the next.
At the end of the trade, I ended up making 140%.
It just gives me so much delight and joy knowing that I can still do something with my financial future.
This is not something that's only for other people. I can actually become financially independent.
Not only allow me to make better trades, more lucrative trades, but have more confidence while I trade.
This Trade Maestro membership is excellent because it's got something for everyone. If you're just starting out, or even if you've been trading for a while, you'll find something you like. You need to get enrolled right now. It's affordable, it's comprehensive, and it's risk-free because you can cancel anytime if you decide you don't like it. So if you want to learn to trade the stock market, or if you're looking to take your trading to the next level, you need to get enrolled as a Trade Maestro member right now. The following presentation is for educational purposes only. All examples and analysis are intended for these purposes and should not be considered as specific investment or trading advice. All examples are for the purposes of teaching and are not intended to suggest future results. The risk of loss in trading securities, options, futures, forex, and cryptocurrencies can be substantial. Individuals must consider all relevant risk factors, including their own personal financial situation, before trading. Options, futures, and forex are considered more sophisticated investment vehicles due to high leverage and are not suitable for all investors. Well, good morning, and welcome to everybody. I am Jeremy Whaley from Maestro, founder and CEO, and it's great to be here with you as we are getting into our live stream for today. We're going to be jumping into day number 17 of the Pick Winning Stocks Challenge. We are rounding the corner. This is the last week. We've got today, tomorrow, and Friday, and then I'll send out some bonus stuff over the weekend, and then we're done. We're done. And next week, we're going to start anew with a completely different setup. So it's going to be fantastic, and I hope you've been getting a lot out of it. I know you have, because I've been seeing your messages, and a lot of you have sent messages in, emails in, and stuff, and it's great. So happy to have you here. So thrilled to be doing this, and ready to jump into today. If you are new, or if you've been here for a while and you haven't done so already, it is time for you to like and subscribe and follow on YouTube, on Rumble, Facebook, wherever it is that you're watching right now. Just do that really necessary thing, because it helps. And what would be even better is if you were to chat a little bit here in the chat, because, you know, YouTube loves that. It helps the algorithm, pushes it out so more people can see it, and that helps me, and it helps you, and it helps everybody. So, and, you know, you can also share it with your friends and family. In fact, some of your friends and family probably could have really benefited from what we talked about yesterday, and they would benefit from what we're going to talk about today as well. All right, with no further ado, let's jump in. We're going to start talking about the market here. We're going to do a little bit of a market update, market overview, starting off to the downside right now, 252 on the Dow, 365 on the NASDAQ, if you can see it here, 255, 365, and down 70 on the S&P. So down a little bit. It was pretty neutral. It was actually a little bit bullish earlier today. But as of the noon hour Central Time, that's where I'm at. Excuse me. Got a little. Excuse me. You know what? You're gonna have to see a blank screen, because I need to drink a little something. All right. Hopefully that worked. Hopefully that got whatever's tickling my throat out of the way. Yeah. As I was saying, we were up a little bit. Nothing major, but we were up a little bit earlier today. Currently, we're down a little over 200 and a little over 300 on the NASDAQ. Taking a look here as I zoom in, you're going to notice we have another one of those small little candlesticks, which, speaking of which, I was thinking about candlesticks this morning. And, you know, we've had so much discussion about candlesticks in the last week. I thought maybe next week would be a good week to do a little bit of candlestick training and introduce you to some of the principles of candlesticks. So if that's something you're interested in, type it in the chat. Let me know. Next week's content has not fully been decided yet, so let me know if that's something you're interested in. But taking a look here, this is a very small candlestick. It's a spinning top is the name of that candlestick. It happens to be a solid candle. It's red. As you're looking at that, you might be thinking, oh, this is really bad. The market's down 200, 300 points. Actually, it's really not that bad. It's this very small candlestick body. And small candle bodies reflect indecision in the market. And it's a logical place to be having indecision. If you can look back here, you'll notice we had a little spinning top doji candle 2 days ago. Yesterday was a pretty small spinning top as well. And then today. So while we are moving somewhat to the downside, it's not with great momentum. It's not with great gusto. And these small candlesticks actually tell you that, hey, there's not a lot of movement here. Now, what we are getting from it, what is important, is we're seeing this indecision at a decision point. And that is actually really important. Whenever we think about candlesticks and we think about the message that we get from candlesticks, this is a decision point on a couple levels. Number one, I can look to the left and see that there was a pivot point here just a week ago. It wasn't a week ago. Sorry, it was about a month ago. About a month ago, we had a pivot point here. So that is a turning point. Excuse me for not having my screen full size there so you can see that better. That is a turning point. And what you're seeing is that the market rallied roughly to that price range, and we started getting these small candlesticks. Small candlesticks show indecision, and indecision at major turning points are usually or often the beginning of the turn in the opposite direction. So if that happens for us, then what we're looking for is we're looking to drop below this major turning point, the one that's in a purple line here, right at 40,000, and I'm looking for a big major red candle to do so. Now, if it just gaps down and it's got a little, doji candle, which is the same open and same close, if it looks like that tomorrow, it'll look a little bit bearish. It'll probably be, 400 or 500 points, but it doesn't mean that it's actually that bad. What you're looking for is you're looking for a little bit more momentum, a little bigger candles, and an increase in volume. And so far, we've had none of that. So we're very much in the same forecast that I've been saying all week. And we may stay there. I mean, we really might. We only have 2 more trading days this week. We got today and tomorrow. Friday, we're closed for Good Friday. I think we're going to just kind of fizzle and fazzle. That's my technical term, fizzle and fazzle. Didn't learn that from a book. I made that one up. But I think we're going to fizzle and fazzle about where we are right now, and maybe next week we'll get a decision. I would love to see the Bulls come back in and just drive this thing back up to 45. But honestly, if the Bears come in and push us down to the mid 30,000s, I'd be fine with that as well. We have good trading opportunities either direction right now. We just need to get this thing broken free. The easy one to trade at this point would be the bearish trade because we've already got all that bearish trend set up. That would be the easy one to identify and say, okay, boom, we're continuing the bearish trend. Let's jump in. That would be the easiest one to trade. But the one that, I think most of you want that, you kind of want to ride as a sustainable trend is going to be the bullish trend. And that may take a little bit more work to get fully reversed and actually going back in the opposite direction. You're looking at the S&P 500 right now. You'll notice that your stochastics, they like it. They're heading up in the right direction. We've got a higher low as you come through here. You can see that. Higher lows, almost like a little bullish trend, and your Stokes have crossed over to the upside. This most recent trading behavior, the last 3 sessions here, basically, it hasn't done anything to hurt the stochastics, but you are going to start to see these lines coming together, closing off, and eventually crossing if the price action doesn't go somewhere. If it just stays flat, you'll see that happen. If the price action comes to the downside, you'll see that happen as well. So we really need bullish direction to keep the indicator going in the right direction. And I'm not sure if we have enough momentum for that. We don't have a lot of volume in here right now, relatively speaking, and we just don't have a whole lot of that type of momentum to fully reverse this. But that's not a bad thing. Again, I mean, I've traded through 1 billion of these. Okay, maybe not 1 billion, but I've traded through a solid handful of these kind of big corrections like this. And it always looks like this right now in this phase of it. So nothing to be overly fearful about. Taking a look over here at the NASDAQ, and it's basically same song, different verse, just like I've been saying all week. Like I said all week last week as well. I'm watching for this one. I think I would kind of be surprised if it doesn't get back to this pivot area just above 16,000, maybe actually into that range right there and really be able to support. And I would like that. I would love that. One of the things you're going to find with me is I really love it whenever we get to the support level and actually really establish it. If we just tap it and bounce, it's fine, but it doesn't establish that pivot area as strongly as if we have a whole lot of hangout there and really pound into the support and the support holds. And so I would like to see that. We're kind of well on our way to do that right now. We only need to sell off another, a couple hundred points to really get there and start testing that. So that's what's on my radar as far as that's concerned. Another big story that has been developing is the gold trade has continued to rally this week. We're up $8 on the ETF, and we are hitting my next target. So this is a trade that we set up in our Profit Picks class. If you were not in the Profit Picks class or you don't do our group coaching with us, then first of all, you should be. Number 2, this is the trade. So we originally got into this trade around 272 was our entry point for this trade. This is our first target, second target, and we are right now, as of today, coming into our third target, 307.75. That means if you were in this trade, you should start taking some profits on it. That's what the disciplined trader would do. Notice what I'm saying. The disciplined trader starts taking profits. It is the undisciplined retail trader who's buying and holding who says, oh, look, it's really high. Let's keep holding. And then they end up selling it at a much lower price. The disciplined trader will trade to this price point and take their profits. And that's the way that I'm looking at it right now. Is this the end of the move? I can't say yet. We haven't seen the signs to suggest that it's the end, but I can say it's been in this part of the trend for a long time. And I think that we're probably on the horizon of having a little pullback before the next phase of the bullish trend for gold. So that's definitely very much on my radar. Taking a look at silver right now. Silver has rallied, but it is very far from being in the same kind of trend that gold is in. It's very much stuck in a consolidation pattern, and nothing that's making me super excited about it at this point. So that's where we are with silver. Let's take a quick look at Bitcoin and crypto. Bitcoin, I've been talking about this support that's been building around 76,000. It is trying hard. I would like personally to see it sell back off to 72 and really establish that support. But if it decides that this is going to be its new pivot area, that's fine as well. We'll end up marking it. We're up another $1,400 today on Bitcoin. If you look at the chart, you're like, yeah, it doesn't really mean much. It's not back above the averages. We do have the 10 starting to cross the 20 period, but there's just not a whole lot of momentum that's built in there yet. So that's where we are on that. The rest of these kind of the same. Let's take a look here at Solana. It has not had a breakout yet either. This is, can you see here how Solana has sold off to its pivot point? In this case, the pivot, let me get you a number for that. Pivot's about 121, maybe 121.50. But you see how it sold off here, made contact again, built on it for about a week and a half, rallied, made contact again, dipped below, back on it. This is what I'm referring to when I say establishing a support. This is clearly building that foundation there. And if you were to use the metaphor of like a building, if you think about the different levels of a building, you got your ceiling, think of your ceiling as the resistance, think of the floor as support. Let's say you broke through the ceiling, you came back down, that old ceiling becomes what was ceiling for the first floor becomes the floor for the second floor, and on through different layers, right? Well, that's kind of the same principle here that you're seeing with crypto, well, specifically with Solana and this support and resistance area right here. We're establishing that support very much like a floor. So I am very optimistic about where Solana is and the foundation it's building, and excited to see how that one shakes out. All right, I think that's all that I need to cover as far as this market update. If you have any questions on it, please type them in. Christina is writing in from Texas. Heidi ho, Miss Christina. Christina, which Christina are you? Are you my student Christina, or are you I don't know your last name. I see it says Christina Louise, but I'm not sure which one you are. So I'm trying to figure out who I'm talking to here, because I got a couple Christinas in Texas. All right. Let's see if I got any questions, comments. Yeah, I'll put my screen back up while I'm doing this. Questions, comments, opposing views over on Rumble. I got nothing for now. All right. Let's keep going then. Rolling. All right, ladies and gentlemen, we are getting into the Pick Winning Stocks Challenge, day number 17, and we are jumping into risk per trade. Now, yesterday, we talked about the risk and the reward ratio. And the risk-reward ratio is the first of the three levers of risk management. I shared this with you yesterday. Said the first lever is risk-reward. The second is risk per trade, and the third is risk scaling. Now, the risk per trade, this is something we're going to stack on top of the risk reward. Remember, with risk reward, we said you do not want to be risking more than you plan to make from a trade. You do not want to be risking more than you plan to make on the trade. So, for example, if you set your trade up and you're expecting to make $2 a share, you don't want your stop to be placed somewhere where if it stops out against you, you're losing $2.50 a share. That's an inverted risk-reward ratio, and eventually you're going to end up going broke if you do those kind of trades. And that's what most people do. Most people have inverted risk-reward ratios. So what you want to make sure you're doing is you want to make sure that you're making more money on every trade that you win than you're losing on the trades that you lose. And if you do that, you're going to be a third of the way down the risk management formula. Actually, this is the most important piece right there. But it doesn't just end there. And here's why. It's possible to set up the right risk-reward ratio and still go broke. Sorry, it is. It's possible to set up the right risk-reward ratio and still go broke. And here's why. Remember, when we think about risk, we're thinking about a game of statistics. you've got a 1 in 3 chance of making a profit with a trade. That means you have a 2 out of 3 or a 66% chance of losing money with every trade that you place. If you're just using the raw statistics. Now I know we make it better. We increase those numbers by doing better analysis and other things. But if we're just going on raw statistics, raw data, you have a 1 out of 3 or a 33% chance of making profit on the trade that you purchase, and a 2 out of 3 or a 66% chance of losing money on that trade. That's your basic raw odds. So let's just assume out of any 10 trades, let's assume that you're going to make money on 3 of them and you're going to lose money on 6 or 7 of them, okay? If you do that, and let's say that on the 3, you make $3 a share, and on 7, you lose $1 a share, over the course of 10 trades, you're going to make a profit. Unless you messed up the risk and reward ratio and scaling. If you mess up your risk reward ratio, then it's going to hurt your long-term equity curve. Your risk reward ratio, where you make $2 or $3 for every dollar that you put at risk, is going to make sure that over the course of several trades, you're growing your account. It's the risk per trade that will make sure you don't wipe out your account. 2 different levers of the same equation, 2 different pieces of it, okay? What do I mean by that? Imagine that you have the perfect risk-reward ratio. Maybe it's the best one you've ever seen in your life. You're putting up $1,000, and if this trade does what you want it to do, it's going to earn you $5,000. It's a 5-to-1 reward to risk ratio. It's fantastic, right? And by the way, this happens quite often with options. What I'm describing to you happens to my options traders often. Put up $1,000 into your option contract. If it gets to your target, you're going to make $4,000 or $5,000. Perfect. Ideal trade. Now, problem is, what if that trade was the trade that did not make your profit? That's the trade where you reach maximum risk. What if out of your statistics, that's the one of the 3 or 4 or 5 or 6 trades that you're going to take a loss on? You say, okay, not a big deal. It's only $1,000, unless your entire account was only $1,000. And now you wiped out your entire account with one trade. Not because you did a bad risk reward, but because you didn't balance your risk per trade. The risk per trade relates to how each of your individual trades relates to your overall trading account. So think about it this way. On an individual trade, you might take a big hit. It might be 25% of your capital that you lose on an individual trade. Nobody's going to be happy about that. But if you've balanced it in the scheme of your overall trading account, a 25% loss on an individual trade does not need to hurt your overall account that bad. That's where risk per trade comes in. So let me go back to my example that I just gave you with the options trade. It's not uncommon to take this kind of a trade where you put $800 or $1,000 or $2,000 into an option and you see a 200, 300, 400% ROI if you get to your target. That's not uncommon. It's also not uncommon on an options trade to see that trade go down and go against you, and you end up losing 25, 30, even 50% of the option premium just because the trade didn't go the way you want it to go. Now, if you're like most Americans want to get rich very, very quickly, and I think that's great. I love that. But the challenge is, in the process of trying to get rich very, very quickly, what most people tend to do is they over leverage. And they'll take, let's say they had a $2,000 trading account, and they'll put all $2,000 into one options trade, or maybe 2 options trades. And now it happened to be that one that took the 25% hit for that options trade, and boom, it just blew up your account because you were imbalanced in the process. Risk per trade is seeking to affect that and seeking to balance that. It's how each of your individual trades relates to your overall account. So let me give you some individual rules or some general rules to go with this. Number 1, be sure to write this down. It's very important. No individual trade should expose more than 1 to 2% of your overall account. 1 to 2% of your overall account with a maximum risk of 5% of the overall account. Now remember, capital does not equal risk. Capital does not equal risk. The amount of capital that you need is what it's going to take to execute the trade. Your risk is the difference in your entry price and your exit price. There's a difference. Just because you put capital in a trade doesn't mean you've lost it. Doesn't mean you've even risked it. Just means you put it up. Okay, risk is what you're saying, I'm willing to actually take this loss. So let me give you an example here. Let's say on an overall account of $100,000, an individual trade should not risk more than 1 or 2% of that. Therefore, one individual trade on a $100,000 account, you can have as much as $1,000 to $2,000 drawdown per trade. $1,000 to $2,000 drawdown per trade. Does this make sense? Let's come over to our charts and let's do some examples here. I'm going to keep it straightforward. Let's do it with QQQ. I wish the Qs were more bullish today. It always makes these examples more interesting when they're bullish, but that's all right. Let's say in a hypothetical universe that you're looking at the Qs and maybe you're thinking to yourself, this is the bottom and I'm going to buy. And I want to be very clear, I am not saying that. I am not saying that. Full disclaimer, I'm not saying this is the bottom and I'm not saying that you should buy. This is all a hypothetical situation. Got it? Hypothetically speaking, let's say that you're looking at the QQQ and you're thinking to yourself, I want to buy this. I think this is the bottom. I'm ready to buy. Well, today, as of right now, the current price is $448.97. Changing on us rapidly. Let's just say that by the time we get into this, it's $450. Nice fat round number. It's easy to do math, okay? So now we have a $100,000 account. And we want to buy, hypothetically, $100,000 worth of QQQ at $450 a share. So what you're going to do is you're going to pull out your trusty calculator, because none of you should have to do this kind of adult math by yourself. You can put $100,000 in there. That's $10,000. Need one more zero. We're going to divide it by $450 a share. And that means you can buy 222 shares. 222 shares times $450 a share is going to be just under $100,000. 450 times 222. You can buy it'd take $99,900 of your $100,000 capital. So you have $100 cash still sitting there. Okay, so let's just assume that you've done that. So you bought 222 shares. Now, where does your stop go? We haven't talked about stops in here. So as far as the Pick Winning Stocks Challenge is concerned, you should be like, I have no idea where the stop should go. But for those of you who know, you know that I'm going to tell you that your stop needs to go somewhere down here. If we went off of a parabolic stop, for example, it would go way down here at 410. That would actually be pretty reasonable. Okay? It would also be reasonable on a trade like this to maybe put it around 430. But let's say that we go with a parabolic stop, because here's the reality. Even though I'm not telling you you should do this trade setup, because I actually don't think you should, but if you were in a hypothetical universe, you really want to go to your last swing low in this trade setup, because it's been very volatile. You don't want to set your stop too tight in a trade setup like this. So we would want to go down to about 410. Okay, so let's use that as our stop. So our entry price is 450. Our stop price is going to be 410. If we hit our risk on this trade, it's $40 per share. That's your risk. Got it? Now, let's really put a hard number to it. Put a hard number to it. It's $40 per share times our 222 shares. So it's $8,800. That is your actual risk you're putting on the table. Now, let's assume that we were to trade this up to our target. And I'll change this to a blue pen for this. And let's say that we were to get to, here's one target, here's another target up here, and let's say we got to our ultimate target about 540. Fantastic. That gets us back to our all-time high. And the difference in 540 and 450 would be $90 per share, and that's going to be your reward. Let's put hard numbers to it. $90 times 222, because that's the number of shares we're trading, would be a $19,000, 980 profit. Now, I don't care where you grew up. I don't care if you were homeschooled or if you were public schooled or somewhere in the middle. Everybody can look at this and say $19,980 profit, $19,980 reward is more than twice as much as $8,800. That's a better than 2-to-1 reward to risk ratio, isn't it? The answer is yes. But here's the problem. We're not planning for just risk reward. The risk reward on this works. Risk reward is right. But what if we actually lost the full risk of $8,800? On your $100,000 trading account, $8,800 is going to be, I'm going to do the math for you, but it's going to be 8.8%. So you're going to take the $8,800, divide it by $100,000, and it's 0.88. You move the decimal over 2 points. It's 8.8%. It was a round number. I could do that one in my head. So here's the problem with this trade setup. If you were to hit maximum risk, you would have a drawdown of 8.8% on your account. That's unsustainable. That's why you can't do this trade. Now, you can do the trade setup itself, risk reward wise, would work. But risk per trade wise, it would not work. So when you look at this and you say, well, what's the most I could risk? We're going to say, well, the most I could risk is $2,000. And the risk per trade, per share, was $40. So I can only do 50 shares. And now you reset the trade. You say my entry price is $450. My stop is $410. It's $40 per share times 50 shares. That says shares. And now your risk is going to be $2,000. And that's 2% of your overall account. Now you say, well, I had a lot more money. I could do more shares. It doesn't matter. The risk per trade is too much. If you hit your maximum risk, it eliminates too much of your trading account. You can't take that risk. Now, the target's still going to be the same. 540. 540, you'll still have a $90 profit. You'd have $90 profit per share. So about $4,000. $4,500. So on this trade, you would risk $2,000. Your reward would be $4,500. That is better. It's 2.5 to 1 reward to risk ratio. Or that's not quite right. It's 2.25 to 1. 4,500 divided by 2,000. 2.25 reward for every $1 you're putting at risk. It's a good risk reward ratio, and if you hit your maximum loss, it's only 2% of your account. And you can sustain that. And that's how we do risk per trade. That's what risk per trade is. Risk per trade is simply taking your individual per trade and saying, if I hit my maximum loss, I live to sustain and trade another day. Now, when you know that, if you know those numbers and you know that over the course of 10 trades, I'm going to win a certain number and I'm going to make a certain value, and I'm accounting that on a certain number of trades I'm going to lose, and I know that if I lose, I can stay in the game, it became an equation. Now we don't have to be afraid of it. Let me show you how long you could stay in the game. This is the chart. How much can you afford to risk? If you are only risking 1% of your account on an individual trade, with an account size of $5,000, your risk is $50 per trade. That's the max risk you can take. If it's $10,000 account, you can risk up to $100. $2,500 account, $25,000, you risk $250. All the way up to $100,000, you risk $1,000. If you're risking 2%, then obviously it doubles. If you go to the absolute max, which is 5%, on $100,000 would be $5,000, on $5,000 would be $250, and you can do the math from there. Now, you might be looking at that and thinking to yourself, well, on that Q's trade, if I only have a $5,000 account, and if I only want to risk 1%, I can only do one share. And the answer is yes, you're right. You say, well, I'm not going to get rich on one share. You're also not going to go broke with it. You know, you got to decide what's most important to you. Is it most important that you get rich quick? Or is it most important that you stay in the game so that you can get rich eventually? You got to decide which one's more important to you. Are you going to trade for success long term? Or are you going to trade gambling short term? This is what happens with so many people that are in the crypto space. We're using QQQ here, but this happens with so many people in crypto. They go buy that meme coin. They bought Dogecoin. They bought one of these coins that was, pumping in the moment. They put everything into it, and then they ended up losing a fortune on it because they didn't understand risk management or trade management. Like, they didn't understand any of it, right? That's called gambling. That is gambling. Now, coming back to my chart here, I say 5% because I understand that if you only have a $5,000 account, I understand that only risking $50 doesn't give you much room to make very much money very quickly. I get that. It's the right way to manage it, but I get it. If you're risking 1% per trade, you'll notice up here at the top in yellow, you can actually have 100 losing trades back to back before you go broke. And even my worst traders have never done 100 losing trades back to back. So you're never going to go broke. Not like that. You can double that. You can go to 2% and you're going to get 50 chances. You're going to have 50 trades back to back before you go broke. Most of you are not going to do that. So that's why 2%, I'm totally fine with 2%. 1 to 2% is a good amount of money to risk per trade. 5% is the max. And the reason is because you can only have 20 trades back to back that would lose before you wipe out your account. On a smaller account, on a $5,000 account, I'll move the margin and I'll say, and by margin, I don't mean broker margin, I mean the percentage margin. I'll move it to 5% and say, okay, you can lose up to $250 on this trade. But you only got 20. You can only have 20 losing trades back to back. And if you haven't got your win-loss ratio, worked out yet, then you don't stay in the game very long. But the thing is, $5,000 isn't really that much money. So it's not going to wipe you out like for your lifetime. I mean, anybody for the most part can sustain a $5,000 loss in the market and live. You know, you may blow out your account, but it's not going to destroy your life. You lose $100,000 in the market, and for some of you, you know, you may have just opened up a new financial crisis in your life, like a true financial crisis. And so the more money you have, I would say the less percentage you should risk. Because number one, you don't have to have it to make interesting money. You know, if you're risking 1% and you risk $1,000 on a trade, you know you're going to make $2,000. Let's say you're day trading with that, you know, a couple grand every day or two is pretty sustainable. So $100,000 provides much more interesting income than $10,000. Make sense? But, you know, if you have a $10,000 account, you may say, well, I'm willing to risk it all using 5% risk management because, you know, if I did lose the 10 grand, I'd be really irritated, but it wouldn't be the end of the world. And that's why we look at it that way. So the bigger your account, the smaller I would say your risk per trade should be. The larger your account, the smaller it should be. The smaller your account, you can take it up to 5%, but that's the most I would do. 5% is the most in per trade that I'm willing to say you can do this. Because if you risk more than that, eventually it's going to burn you. Okay? All right, a couple of takeaways here. Number one, risk reward will help you stay focused on trades worth taking. So yesterday we talked about risk and reward. If you do bad trades that have a bad risk reward, it's a trade that's not worth taking. Risk reward will help you focus in on the trades that are worth taking. Risk per trade will help you avoid too much exposure on those trades. These are the first two levers of the equation for risk management. Tomorrow, guess what we're going to do? Talk about more risk management. And I'm going to show you how you can actually extend this. So even if you're using a 5%, I'm going to show you how you can stay in the game even longer because there's no reason to ever go broke, period. There's no reason. You do not need to go broke. You can have a lot of losing trades back to back and not go broke. Not blow out the account completely. And that's what I want for you. I want you to feel security about it because here's what happens. Once you know these numbers, once you know, let's say you get your win-loss ratio to 50%. So half your trades you make a profit, half your trades you lose. If you have your risk reward worked out and you know on the half that I make a profit, I make $2 per share, and on the half that I lose $1, well, how fast are you going to try to blow through those losing trades so you can get to the 5 winners? Pretty fast, right? So you say, okay, it's just an equation. Now, if we add in this risk per trade, it becomes an equation that sees your equity curve going up and one trade doesn't blow you out. Now you're planning for the loss. You're accounting for it. It's like Robert Kiyosaki says, if you plan for the worst days, you'll only know good days. And that's what we're doing here. We're taking this idea of trading that so many people think is gambling. We're taking this idea of trading that so many people think is, you know, just a crap shot. It's just throw the dart at it and see what happens. There's too many high frequency traders. There's too much manipulation. All these stories that you've heard about trading for all these years that has kept people off balance, and we're alchemizing it. We're balancing it out. So you realize, okay, there is a plan. We're doing the right analysis. That's step number one. It's not random. We're going to actually choose trades that are moving in a specific direction. We're actually going to know the trade setup, the entry, the target, and the stop. So we know our risk before we get into the trade. We know our profit before we get into the trade. We're going to use strategies that work for that trade direction. And then when we do have a losing trade, because we're going to account for it. You will never hear me out here saying, oh, just go buy such and such. You know, you're never going to lose money in the market. Market always goes, you will never hear me say that. It's just a flat out lie. It's BS. People who tell you that, people who tell you just hold it, it'll eventually come back, they are just giving you terrible advice. Don't listen to those people. The reality is you're going to have losing trades. So since you know it's going to happen, plan for it. Plan for it. That's it. And then when it happens, you say, oh, I planned for this. We're good. You flush it, you move on to the next one. Are you happy about it? No, I'm not happy about it, but I planned for it. Since I planned for it, it works in my plan. And now you're actually putting yourself in a position to see your equity curve going up. All right, folks, any questions about this? We covered a lot here. Covered a lot. Let me look at my stream here. We've got few introductions, no questions over on YouTube right now. I realize there's a delay between when I speak and when you can type your questions. So I'll try to give you a couple minutes here. If you got any questions, type it in there very quickly. If you've not followed the channel yet, if you're over on Rumble, please do so. We are growing that efficiently. We've had a 5x growth in a week. We started with 5 people, but hey, we've had a 5x growth. Growing that over there on the Rumble, growing our YouTube channel as well, and we're wrapping up our Pick Winning Stocks Challenge into this week here. So that means next week we're going to be looking at the next phase of what we're doing with our live streams. And I announced on Monday, the future show is going to be Wall Street Secrets Live. So we'll be sharing some more about that as we get closer to it. All right, like and follow, like and subscribe, whatever you need to do. If you got any questions, type it in there. If you don't have any questions or you just don't get to it fast enough, send me an email, jeremy@trademaestro.com, jeremy@trademaestro.com. Thank you for being here. For those of you who are my regular Trade Maestro members that happen to be watching today, we do have a group coaching tonight, and we will be doing that live at 8 o'clock Eastern, 7 o'clock Central. If you are not a member at Trade Maestro and you would like to join our live group coaching tonight, we will be doing that tonight at 8 o'clock Eastern, 7 o'clock Central. All you need to do is become a member over at TradeMaestro.com. Become a member over at TradeMaestro.com, and you can get in tonight. We'll be doing the live session. We'll go into Zoom. You'll get a link for the Zoom meeting, and then you can open your microphone and talk, and we can have a dialogue about all that. So that'll be tonight at 7 o'clock Central Time, 8 o'clock Eastern. All right, thanks for being here, folks. I wish you guys the best. Happy trading to all of you. I'll see you tomorrow. Until then, we'll talk to you soon.